한경글로벌마켓의 김현석 뉴욕특파원입니다. 금리는 연일 치솟고 있고 중동에서 이스라엘과 하마스의 분쟁은 자칫하면 이란으로 불통이 튈 가능성이 커지고 있습니다. 원래 주식시장은 이맘때쯤이면 연말 랠리를 준비해야 될 그런 시간인데요. 지금은 약간 이른 듯하게 느껴지고 있습니다. 이런 복잡한 상황을 좀 풀어줄 분을 모셨습니다. Bca리서치의 게리에반스 글로벌 수석 전략가입니다. 이분에게 여러 가지 현재 주식시장과 세계 금융시장에 대해서 궁금한 것을 물어보겠습니다.
The bond yield rose almost 5% today. What do you think the bond yield will go further?
In general, we think that the bond yield's pretty close to a peak. And there's a couple of things that drive the peak in bond yields. Mm-hmm. The first is that in history, the last 50 years, the 10-year bond yields peaked plus or minus 4 months around the last Fed rate hike. Mm-hmm. So we think it's pretty clear that July was the last hike. Mm-hmm. And so the peak of bond yield sort of around now would be about as late as it would normally be. Mm-hmm. Secondly, if you look at it in history, we've never had a situation when you've had rising interest rates when the 10-year yield has gone above the Fed fund rate. Mm-hmm. So the Fed fund rate currently is 5.3. As I mentioned, we don't see it going higher than that. So it could go a little bit further. I'm sure it will test 5. Maybe even in the next few hours, but I think it's extremely unlikely to go above 5.3. And then, also our economic view is that we are heading for recession. It's always very hard to know the exact timing. I think probably the first half of next year, the US will fall into recession. We'll start to see unemployment rising. And when that happens, then bond yields will be expected to fall.
And however, who expect yield to rise further, cite the still strong US economy? Do you see the September labor market, jobs report, and the CPI, the retail, everything is strong. And also increasing supply of the bond as a reason. How do you say about
so I think on the economy, it's certainly relatively strong. I wouldn't say that it's absolutely confirmed to be strong. There are some signs of data weakening. If you look at, for example, the beige book that came out yesterday, is a sort of Fed survey of what their regional offices are saying, that had a decidedly soft tone about it. If you look at the ISM, the manufacturing ISM is below 50, the non-manufacturing is only just above 50 and fell quite sharply last month. If you look at the labor market, for example, the number of quits, so people leaving their jobs, has fallen sharply. And people normally leave a job when they've got another one to go to. So that's a sign historically that unemployment is going to pick up soon. So, generally it's pretty strong, but I would say the first signs that high interest rates are affecting the economy, those first signs are coming through. On the supply side, I think that's been the main reason for the rise in yields recently. If you break down the bond yield into inflation expectations, mm-hmm. the real rates and the term premium, in 2020, 2021, inflation expectations went up. They've been very flat this year. Beginning of this year, it was mostly real rates that went up. And that's a sign that the market believes the Fed is being tough, being hawkish on inflation. And in the last 2 or 3 months, it's mostly been the term premium. The term premium is really a reflection of supply and demand. If you studied finance, you know that there should be a positive term premium. You should get a risk premium for buying long-term bonds relative to short-term bonds. But actually, most of the last 10 years, the term premium has arguably been negative. It's just turned into positive territory. And we've got a lot of issuance out there. The Treasury has issued bonds net this year equal to 7.5% of GDP. So I think we're getting a renormalizing of the term premium, but it's probably only got about another 50 basis points to go. So that will be compatible with my argument that 5.3 is a sort of the absolute maximum level that you'd expect to see 10-year bond yields go to.
A current level of yield negative for stocks, and the S&P 500 index is still above 4,300. Even on days when the rates rise significantly, and this week, stock prices are rebounding.
So it's been a bit mixed. There were times when stock prices went down, when interest rates were rising sharply. And it's a bit misleading, the overall index, because it's still basically been driven by, the Magnificent Seven, a small number of internet and AI related names. If you look at the equally weighted S&P 500, that actually peaked in February and is down year to date. So it's a bit of a mixed picture, but as I said before, the US economy currently looks relatively robust. That's helped earnings. Earnings numbers, we're in the middle of the earnings season now. This looks like probably going to be the first positive season of earnings growth after 3 negative earnings seasons. So, the economy is still moving reasonably healthily at the moment. So, unsurprising, therefore, that equities, they are down about 7-8% from their peak, even the headline S&P 500. But, they've not collapsed yet. That's absolutely true.
How likely is that the Israel and Hamas conflict will spread to Iran? If this conflict doesn't spread to Iran, will there be any impact on the market?
So I think the oil price, which is, as far as the market's concerned, that is the major impact of Middle East conflicts. The oil price has started to price in a little bit of a risk premium. We've got Brent a little bit over 90 at the moment. The view of BCA's geopolitical strategies is that there is a fairly high probability that the Hamas-Israel conflict is going to spread more widely in the region, certainly to the West Bank, probably to Lebanon, maybe to Syria. And then when Iran gets involved is obviously the big question. And the fact that you've had President Biden and today British Prime Minister Sunak in Israel, in the region, is they're clearly very worried about this. Iran is key because it controls the Strait of Hormuz, and about a quarter of global oil flows through that. So if there is a global crisis, you could imagine Iran would react by sealing that strait, by closing it off. There's also the issue that Iran exports about 1 million barrels a day to China in contravention of the embargo on Iranian oil exports. And the US has not been aggressive at trying to control those Iranian exports. But if they do, and the Biden administration is looking increasingly hawkish, again, Iran could react to that. So it's certainly a reason to expect that the oil price may well rise further. We think even without a conflict, you'd expect to see oil prices rise to 100, Brent crude rise to $100 a barrel.
In this year?
Before the end of this year is the forecast of our energy strategists. And then next year to maybe about $118 a barrel. But if there is a global conflict if there is a regional conflict in the Middle East, it could go further than that. Offset by the fact that I think Saudi would not, and UAE would not want to see the oil price rise too much, because they know that would kill global growth, and that would hurt their interests. So they do have quite a lot of new supply they could bring on. But certainly the probability is that oil prices will continue to rise from there. And so I still like the energy sector. I would still have exposure for countries like Mexico, for example, a big oil exporter. That this is good news.
Natural gas price in Europe are rising again, almost 40% in 2 weeks. And is it possible that natural gas will skyrocket again in this winter, like last year?
Yeah, so you really need to ask a weather forecaster rather than a market strategist, because what happened last winter was that the winter was very mild in Europe. So will we have a normal winter? If we do, I think there is a distinct risk that natural gas prices will rise. If you look at the performance of European stocks, they are very correlated to natural gas prices. And if you think about it from a geopolitical point of view, there's 2 things Russia would like. Number one, they'd like President Trump to be re-elected. And number 2, they want Europeans to get bored and tired of supplying weapons to Ukraine. So it's in Russia's interest to push up the price of natural gas, push up the price of oil. They would like to tip the US economy into recession. They'd like to tip the European economy into recession. And they have the weapons to do that. So I think it is a distinct risk for Europe. And the problem is that already the European economy looks quite weak. It's a very manufacturing-based economy, and manufacturing, PMIs for manufacturing globally are below 50. The ECB, despite that, has raised rates. We think they've made a policy mistake. So as you say, if you were to add to that a rise in natural gas prices, that could be a very big problem for the European economy.
There are many uncertainties you mentioned. And will there be a Santa랠li this year? If you think there is it a good idea to buy stock now, or should I wait a little longer?
So it depends a bit on your risk appetite and your willingness to trade in and out. We do often get a rally in stocks, as you say, a Santa rally in the last month or two of the year. I think a lot will depend on China, frankly. And if we see signs of further stimulus coming out of China, that could certainly be a reason to have a bit of a rally, particularly in the very cheap now manufacturing stocks and things like semiconductor stocks, in material stocks, in the metals miners, for example. The Chinese GDP data yesterday was, however, probably good enough. The quarter-on-quarter annualized GDP number was a bit above 5%. So if they can keep that up in Q4, they will achieve their 5% target for this year. So they may well now feel they've done enough stimulus. So it depends on your appetite as an investor. As I mentioned earlier, I would look for a recession to begin in the first half of next year. Typically you get a recession about 2 to 2.5 years after the Fed first raises rates. And about 9 months after the last Fed rate hike. So all those things are pointing at the first half of next year. The stock market typically peaks 2 months before that. So could we see 1 or 2 more quarters of rebound in stocks? It's possible. But if you're a conservative investor, and that's who I typically talk to, wealth managers and pension funds, on the 12-month time horizon, it's always very hard to get your timing right. I would recommend those people to be conservative already.
And if I decide to buy stocks, should I buy a tech such as a Magnificent Seven, or would the other stocks that have been relatively neglected be better?
Yeah, so in the long run, I still like the tech sector. I think AI is a huge change. I haven't seen anything in my lifetime since the internet that seems to me to change the way everything works. Getting exposure to cloud computing, software as a service, robotics, big data, all those things make a lot of sense in the long run. So I would have a strong structural bias to like those sectors. Having said that, however, they are expensive. There's a lot of good news priced in. We saw, for example, this week, NVIDIA's stock fell back on suggestions that the US was going to get tough on allowing it to lend to sell to China. We've seen the same thing with Apple, where suggestions that the Chinese government was banning public servants from using iPhones. That hurt Apple stock. Ultimately, what it comes down to is when we have a sell-off in stocks, and I think we will have one in the next, say, 6 to 9 months, people sell what they own, and what they own a lot is those tech stocks, those Magnificent Seven stocks. So in the short run, I reduced my weighting to neutral at the beginning of this month. I certainly want to have some exposure there, but I do think that there's a risk of a sell-off. The key thing to look at probably is the next NVIDIA earnings announcement, which will come out next month. The high expectations that the extraordinary growth that they've achieved this year, that will continue. And if it does not continue, that's potentially a problem. I think that stock could sell off quite sharply.
How long do you think the strength of a US dollar will continue?
So the US dollar looks very overvalued. It's probably 35% overvalued relative to its fair value based on purchasing power parity. So if you look at the long run picture, 5 to 10 years, purchasing power parity is a very good guide. For example, against the euro, I would see the dollar depreciating maybe 3 to 4% a year for the next decade. So I think quite possibly we're at the early stages of a dollar bear market. And in history, those have lasted 5 to 7 years. However, the dollar is a very counter-cyclical currency. It always appreciates in recessions, has a strong inverse correlation with the stock market, particularly in recessions and bear markets. And ultimately, what it comes down to is relative interest rates. And as we've been talking already, the US economy looks relatively resilient. The economy of Europe, the economy of emerging markets, the economy of China look really quite weak. And so US rates are likely to stay high. So interest rate differentials are likely to be quite positive for the dollar as well. So we would probably see another maybe 1 or 2 quarters of upside for the dollar. It would typically peak sometime in the middle of recession. And as it becomes clear that coming out of the recession, the growth is picking up, that tends to be better for Europe, better for China, etc. That's when you see rallies in other currencies. But until then, there's probably a bit more upside for the dollar.
Among global markets, is the U.S. market still the most attractive? And are there any markets you recommend?
So the US market is the most expensive. Forward PE ratio, probably 18.5 times. Most of the rest of the world is 12 to 13 times. But there's a number of good reasons for that. So I do prefer the US. The US has much higher ROE, return on equity, than other markets. It's a less volatile market, lower beta. So it typically outperforms in recessions. It's also the US economy is much more services driven, and services are more stable, structurally growing, whereas markets like the Eurozone, Japan, Korea, many emerging markets are much more manufacturing based and therefore much more cyclical. So in the world, the time, frankly, to be short, to be underweight the US is in the early stages of an expansion, and we're not there yet. So that's what I'd be looking for when we know we're in recession. Recessions on average have lasted a bit less than a year. Maybe 6 months into that recession is the time to be moving out of the US into those more cyclical, higher beta markets. But I don't think it's the time yet.
What are your opinions on the Chinese economy and stock market?
So the economy is probably stabilizing. The data we had earlier this week for things like retail sales, industrial production, and the GDP suggested that the fairly modest stimulus that they've done this year in a couple of interest rate cuts is probably enough to stabilize the economy. What would worry me really would be the longer term story. So the government is targeting 5% GDP growth this year. They'll probably target something similar for next year. But if you look at what is the underlying potential growth of the Chinese economy, it's frankly not as high as that. So when you think about GDP growth, it's relatively easy to model it. It's demographics and productivity. Well, in China, the working age population is shrinking 0.5% a year. Productivity growth is only about 1.5% a year. So those two only add up to 1. Where do we get 5% growth from? So as far as the stock market is concerned, I would go as far as to say for a long-term prudent investor, China is almost uninvestable. We've got this likely disappointment in growth because they won't achieve 5%. The quality sectors, genuinely privately run, the internet platform companies, for example, have now largely been nationalized. So the government has taken a controlling voting stake in companies like Baidu and Tencent, etc. The cheap companies are all very state controlled, the banks, the steel companies, etc. I wouldn't buy those either. And we have this regulatory environment in China where it's very haphazard, very random as to what the government is going to come in and regulate. So I don't really see any need to be invested in China at all. Now, if you're a bit more speculative, there are certainly some very cheap companies out there. If you think that China will do a bit more stimulus, maybe buying some of those distressed companies might make a little bit of sense. But for anything other than a quick trade, I would be avoiding China completely.
I would like to ask you about the Korean stock market and Samsung Electronics stock. What are your thoughts?
Yeah, so I'm a macro strategist. I don't cover individual stocks, so I don't have any insights into
but these are
electronics.
semiconductors.
As far as the Korean market is concerned, I mean, why Samsung is important is because the Korean market does move very much in line with the semiconductor cycle. And, despite all of the excitement about AI and NVIDIA, unfortunately, that's not what drives Korean or indeed Taiwanese semiconductors. It's much more down to the basic DRAMs, NAND flash, etc. And those still look to us as if they've got a little bit more downside to go. The global manufacturing sector, as I mentioned, still looks pretty weak. The PMIs are below 50. So I wouldn't be buying semiconductors yet. For Korea, there's a couple of other problems. I mean, one is the weakness in China, and obviously quite a lot of Korean exports go to China. Consumer confidence is very weak. The housing market in China looks exactly like a bubble in the process of bursting. It's got a lot further down to go, I would think. So I think that means that consumer spending in China is going to remain relatively weak. And the final thing for Korea that matters is the currency. And it's an obvious tool for the Chinese government to use to allow the renminbi to weaken. It's at a 15-year low. And we've seen the impact that is having on emerging market currencies, including the Korean won. And that, I think, is something that probably continues. So, Korea is a a grown-up market within EM. It's, a developed country. I mean, I would even question why Korea is even in the EM index. Frankly, Korea's in the OECD, etc. Valuation-wise, it looks quite attractive. So, within EM, it certainly does look one of the more attractive ones in the long run. But I think just at this point of the cycle, it is very driven by semiconductors, and there's probably a little bit more downside for the semiconductor cycle to go. So I would probably have a sort of neutral weighting on Korea. I wouldn't be within emerging markets particularly negative on it, but I think it's the wrong time in the cycle to be aggressively buying Korean stocks at the moment, particularly if the currency matters for you. I mean, obviously, it matters less for Koreans, but I'm talking to my US clients about the Korean market. The risk for them, I think, is that we get a further depreciation of the Korean won, which obviously hurts their exposures when they're thinking in US dollar terms.
Thank you very much. It's my last question. And thank you for every answer. They're very concise and insightful. Yeah, thank you for being with us.
All right. Well, nice to talk to you. Thanks for your questions.